Hey, good morning, everybody. All right, I've got 7:30 on my computer clock, so I think we'll just go ahead and jump in and get started. I always do appreciate you guys calling in live, and as always, I'm going to keep everybody muted so that the recording is clean for the people that watch it online. And if you have questions, use the chat function, and I'll do my best to try to get them answered. All right, yeah, so here we go. So this week, obviously, the big news is oil, right? Everybody's scratching their heads trying to figure out what to do with this new reality that oil or that any commodity can actually trade negative. Um, and that prompted the government to go ahead and finish another $500 billion spending bill to give us all free money that's going to be forgiven. Unemployment lines are growing, and in some places are up as high as 25% is what I've seen, including in Michigan, California, all in the high teens to mid 20s. That is causing the shutdown, along with the unemployment, has caused food demand to decrease, right? So you've got the packers that are closing because for two reasons. One, they're closing because uh, their workers are getting the virus, but the second reason they're closing is that the restaurants aren't open, and so nobody needs the food. Because we're finding that as we eat at home, we actually consume less food, so you've got kill rates down like 36% in cattle and 25% in hogs. Um, so we have uh, guys in the hog business that are euthanizing pigs. We're euthanizing chickens. We're dumping eggs out. We're dumping milk out. All this infrastructure that's built to move product to the restaurants is just not being needed. So the result of that is kind of counterintuitive because it means we have higher prices on our grocery stores, but lower prices for the commodity on the front end. And if you think about it, it makes sense. If they're not generating the product and the grocery stores can't keep up, then those prices rise, right? Because you have demand and less supply. But if our entire feed infrastructure um, uh, from the breeding programs all the way through are designed to meet a specific kill capacity. It takes a long time when that kill rate drops. It takes a long time to back that down. So your first thought is, well, that should be bullish for feed grains because there's more animals, we have to feed them longer. And while that's true, it's bearish long term because there's going to be fewer animals um, if these trends continue. So that puts kind of front and center the great debate going on is, will we have a V-shaped recovery or not? When we turn the country back on May 3rd, will it come roaring back to life, or will it be a slow, drawn out process? And um, so I think the only answer to that is time, because I don't think anybody has any idea what's really going to happen. But the reality is, oil prices went negative, right? And for those that don't know how that could happen or why, let me give you a quick understanding of it. So anytime there's a futures contract in any commodity, there is a physical delivery component. If you are holding a corn contract on past first notice day and the day that you are and at expiration, then you will be obligated to deliver those physical bushels to a grain terminal in Chicago, and that terminal is going to charge you storage. If enough people, or if the store are delivering and the storage is full, their storage rates go up so much that it makes your corn worthless. And that's exactly what happened in oil this week. The facilities in Cushing, Oklahoma, which is the delivery point for the um, for the WTI contract, the storage is full, and so they didn't have any room to go. So they jacked the storage rates up so high, it pushed the commodity negative because you have to deliver it and pay the storage. So that's what happened and why oil plummeted to negative $40. The other thing that's interesting is that typically oil trades with what we would call an inverse. They would call it backwardation, where the front month is higher than the out months. And today we have carry or contango in the oil market, which is very unusual for that market. But what we're seeing is the June contract just collapse right down to where May was. So the oil market's not buying this V-shaped recovery that they keep talking about, because it continues just to just pummel prices. So the great question is, and I think everybody that trades commodities came to work on yesterday thinking, okay, can agricultural commodities turn negative? And the answer is yes, but it's extremely unlikely, because we can store our commodities on the ground, right? We can buy more grain bags. We can create ground piles, so that should keep it from falling to zero. But with ethanol tied to oil and gas consumption, the picture for corn does not look good. And if corn is really going to trade a lot lower, that's not going to bode well for any other ag commodity either. So the outlook isn't great, but the selling doesn't have to happen yet. So let's look at the charts and see exactly what they're looking at. Because it's kind of hard to say, well, hey, we're not that bearish right now, but we're very bearish longer term if the present fundamentals continue. So let's start with corn. This is the May corn contract. We'll kind of walk through each one. Last week we talked about this 13. We talked about these divergences, and they stopped out, and we've traded below them. But look what's happening. We have a whole nother set of repeat signals coming on board here, ready to trigger again, and this divergence is actually becoming more powerful. So yesterday's move, although we tested 301, didn't break through it, this move may not be done because we don't have any type of chart reversal, right? We didn't finish a hook reversal on the daily chart. We just don't have anything to hang our hat on that says, hey, this move to the downside is probably done. What we do have is a set of repeating signals. And when these signals repeat themselves, they just reinforce. It doesn't invalidate them or make them less likely. So even another leg lower is more than likely just a reinforcing signal that corn's fishing for a low. If it breaks it, it's because, if it can't break it with these fundamentals, then when can it? I think everybody is on that side of the boat. So as long as we trade below 320 in the May, there is a risk that it will work lower. But May is moving off of its lead month status, and we're switching to July. So July is even more powerful than May from a technical standpoint today, because that's where the volume is, and where the most amount of traders are trading. Here we've got the same thing. July is further along in its count than May to a repeat 13, which could trigger as early as tomorrow. The divergence down here is continuing. For those that don't know divergence, what that means is that the trade action is not being reinforced by the enthusiasm or panic of the sellers. So there's just not as much momentum as there was. And so when you have waning momentum and decreasing price, that's divergence, and something that is typically associated with highs and lows. So a trade back above 325 in July would be considered the first sign of that a reversal could be intact, or a new low followed by a bounce. And you'll see that here in just a second on soybeans, because that's exactly what they did. So as far as the corn market is concerned, we definitely have, hold on, let me get those muted. Sorry, for some reason I can't get these. There we go. All right, there we go. Now I've got to mute it. So sorry about that. All right, so if corn can trade back above this 325 level, then that would be your first whiff that this is more of a reversal type pattern, or it can go make a chart reversal, right? That I'm going to show you in beans. So corn, longer term, the fundamentals are absolutely horrific for corn if with oil where it is. I mean, we're talking ethanol. No ethanol plants are viable. As of next week, we expect half of the ethanol production to be shut down. We think, if that continues, then if these price levels continue, then ultimately they will all close, and that's about 4.5 billion bushels of corn. So nothing bullish there longer term if these prices continue. So if we get a little bit of a rally in this market, a rally should be sold and sold heavily and get that risk out the door, transfer it to someone else, and you can always look to re-own them later or make an adjustment to that position later on. But into a rally with this set of fundamentals, it's not something that we want to own longer term. So let's look at soybeans, because this could be corn's saving grace. We talked about a chart reversal. We got a big one yesterday in beans. Beans rallied 20 plus cents off of their lows. They made a new low for the entire move, turned around, reversed, came back above this this prior low here, and took out the prior day's low. That is perfect for a reversal. And if you look at the lower indicators and you measure from this peak here with lower lows, we have a big divergence that's repeated from the divergence we signaled here before. So beans are really suggesting to us that that this could be the low. The only thing that is questionable is that's only a 10 count. So we could see lower lows here. But let me tell you how this indicator works. We do not have to get lower lows in order to get a 13 here. We can trade higher, and that 13 can happen in the same price level. It just can't. It just has to be below this 8. So a lot can happen here, and we can still trigger a 13. But the best reading, you have to go with the signal that's the most recent. And the best reading that I can come up with today is that this divergent signal coupled with that reversal is at least a short-term low in beans and maybe something more significant. A trade back above 858 would be, in everything that I understand, would be a signal for a new bull move and a very strong signal that the low would be in. So we'll see what happens. I don't think that corn can go to 2 and beans go to 10. To me, that just isn't logical. Clearly, the market doesn't care what I think, and it can do whatever the hell it wants to do. But that just seems way too far apart. So more than likely, you might see corn have a short covering rally and beans explode, and then we have to revisit things and see what's going to happen. We're planting. The market's going to be pretty volatile for the next 60 to 90 days as we get our heads around what kind of crop we have. Also, pay attention in China. I know the press is bagging on China, everybody's bagging on them, and everybody's talking about how we're not making purchases. But if you read all the articles, it's very clear that they are making structural changes within their territories and government to ease the way for more imports in finished products and in ag products. So China is not sleeping on phase 1. It's not a dead deal, and it could surprise people if they come in and start buying. So the short side in beans seems very limited for where we are, and the risk reward seems to be to the upside, not the downside. All right, let's take a look at wheat. Wheat has a really interesting setup. First of all, here's the bearish setup, right? We have uh, potentially a triple top on wheat. We rallied 30 cents on Monday, and we couldn't hold the recent highs. And make no mistake, that is not a bullish sign. But on the other hand, we're trading in the upper edge of 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 this recent congestion zone, and that is bullish. So you've got a triple top, but you've also really got more of a flag formation that's being built. If you draw a trend line um, off of these two lows and off of from here to here, you actually have the formation or the potential formation of a bull flag. It's kind of a weird one, but nevertheless, that's what that is. So a move back above 513 is extremely bullish in wheat and something that should be bought. So we haven't seen a whole lot of momentum in this last up move, but with the exception of Monday. But overall, the best reading on this chart is that this began a new move. This is a counter trend pullback, and we're tracing a bullish flag configuration that points significantly higher, upwards of 550. So there is a chance that wheat could come up and test this longer term resistance level. Let me pull that down so you can see it. This is the high of last June, and there is a chance or a probability that that might happen. So now anything can happen, and I'm not saying it's going to go there, but from a technical and speculative mindset, you can't discount that possibility. And so you want to be trading to the long side in here until you take out these lower lows. So here's our hedge line. And honestly, anything above 470 is bullish wheat. Anything below 470 is the opposite, and it is not going to be a pretty sight. So what we're doing is we moved puts up to $5 yesterday, and we're trading long futures above it. Right here's our stop. We're going to manage it very tightly, 495. We're going to exit the futures and hold our puts, and we'll put the futures back right on right down in here and take another bite at it, because that's a pretty nice risk reward. I don't know what the risk is to the downside. Clearly, if we break these lows, we can move as much as 80 cents to the downside. So here we're sitting with a potential 50, 60 cent move to the upside and some risk to the downside. But for now, I think the risk reward is up. So let me show you what we did in the spec program this week and show you how that ran through. For those of you that don't know, we've been following that since February 1, and this is a hypothetical account. This isn't a real account, but it's tracking virtually close. I mean, I think it's 95%. We're not taking account for commissions. We're not taking account for some of that stuff. But and this is week to week here. So these are the trades that we closed out over the last week, and these are the current positions that we're in. So currently we are long beans, long wheat futures, long corn puts, and we're offsetting the long wheat futures and long bean futures with long bean puts. So we did make some adjustments yesterday, and the net result of all of that activity is a gain over last week with a $4,600 profit on 10,000 invested on February 1st or thereabouts. So, and as always, there's no guarantees what might happen in the future. These markets are going to be volatile. They're going to remain that way. If you are looking to reduce downside risk, look to sell the corn rally. The other two, I don't have any good signals on those yet that would say that we have the bearish fundamentals that corn does, but certainly we'll be watching it and we'll be talking about it. So if you have any questions, please don't hesitate to call me. We'll be available, and we will talk to you next week.